Thank you for listening to CFB Talks Digital Assets. This recording is for informational purposes only and should not be considered investment advice. It is not intended, nor should it be considered an invitation or inducement to buy or sell any of the underlying instruments cited, including but not limited to crypto assets, financial instruments, or any instruments that reference any index provided by CF Benchmarks Limited. This recording is not intended to persuade or incite you to buy or sell a security or securities noted within. Any commentary, interviews, and discussions are opinions only and should not be considered a personalized recommendation. Please contact your financial advisor or professional before making any investment decision. Some of the underlying instruments cited within this recording may be restricted to certain customer categories in certain jurisdictions.
Then what do we think of PayPal dollar, or whatever it's called, PYUSD, the new stablecoin announced by PayPal this week?
What you're seeing essentially is, a major established financial institution harnessing blockchain technology. We all want to strive for fully decentralized protocols and networks, but overall, you're still getting more adoption into the space. So,
Cristian, are you gonna use this new PayPal dollar?
Well, jury's still out. I mean, let's see. I like to give things, a bit of time to really see how they stabilize. But it's interesting that you bring this out. It seems like it's not only something that PayPal is planning on doing. So it seems like Paxos is intending to release these sort of stable coins for other traditional companies. So I think this is overall great for crypto. It'll just bring, broader adoption that goes beyond the traditional crypto ecosystem. And that's always good and welcome.
You're listening to CFB Talks Digital Assets, the home of informed conversation about crypto for institutions building the future of finance, presented by CF Benchmarks. I'm Ken Odeluga, Head of Content, and I'm joined by Gabe Selby, our Lead Research Analyst. Hey everybody, thank you very much for joining us for another episode of CFB Talks Digital Assets. Now today we are going to talk about the CF Digital Asset Classification Structure. It is the fairly unique taxonomy for the digital asset universe provided by CF Benchmarks. We have actually talked about this in the past, but we thought today we'd do a much deeper dive on that subject. Now to that end, we are joined by our colleague, Cristian Isac, who is CF Benchmarks' lead quantitative research analyst, and he's also a product manager. So, Cristian, we are stoked to have you. Welcome aboard.
Thank you very much. I'm excited to be here, guys.
Brilliant. So, Cristian, I think just to get things going, let's examine that question. Why do cryptos need a taxonomy? Why do cryptocurrencies need a classification system at all?
Yeah, thanks for asking that, Ken. I think it's a good question and an important one to ask yourself in the crypto and the blockchain economy. In essence, when we first incepted our classification structure, the DACS, the main idea was for it to help investor better understand and sort of make sense of the blockchain economy, which sometimes, especially at the beginning, was not an easy feat, given it was still and still is a relatively new technology. The use cases of crypto grew very rapidly, and so it was very easy to sort of lose yourself in a notion of new buzzwords, applications, and use cases. So a crypto classification structure, just in the same spirit as the well-known global industrial classification structure that is better known as the GICS in traditional finance, helps the investor to get an intuitive understanding of the blockchain economy, and most importantly, to better understand their portfolio, better understand their risk exposure, or where their return is coming from. This way, they can practice, first of all, financial discipline, and therefore make informed investment decision. So, in a nutshell, I would say that it is very important to have such a crypto taxonomy structure, if you will, to really get a good grasp of the tokens that one might invest in and put their money at.
When we look at a classification structure or taxonomy on the blockchain economy and how it should all work, I think there's instances where you'll probably find out that the way the blockchain economy works with their tokens can be very specific to digital assets. Additionally, there are examples where you might find that they're quite similar. So just to give you a quick example on how things could be quite different, a large category of tokens could be categorized as like a utility token or that style token, which is essentially if you have a blockchain that serves as a layer 2 blockchain. So this is a blockchain on top of a blockchain is what that means. And maybe this could be used for scaling. That's something that's quite popular in the layer 2 space. Basically, if you're going to use that layer 2 blockchain, the utility token will be used to execute transactions on that blockchain. You will pay the transaction fees using that utility token. So there's this inherent tokenomics, this demand that if you are a viable scaling solution on a layer 2 that's settling on a layer 1, such as like the Ethereum network, you're going to see a demand for the value of those tokens just kind of build or ebb and flow as the demand persists. So another example now where I think things should be quite similar is when you look at these decentralized autonomous organizations. You've probably heard of this term called DAOs. That's what it stands for. For these types of organizations, a lot of these issue these tokens, which are basically very akin to voting share classes on common stock. So if you own these tokens, you're going to be able to vote on proposals or initiatives or changes to how the protocol operates. So it's very, very similar to how a voting share class would work in a corporation. But I think it's these nuanced distinctions that make it important to have, I think, a crypto kind of centric classification structure for practitioners. So when you look at, to me, how does the blockchain economy work and its unique characteristics, and how are institutions going to use the taxonomy that's more tailored to this asset class? Basically, you're going to find use cases for investors where they're going to be, as Christian was saying, measuring their exposure, to various categories or segments. But it doesn't have to stop there. Researchers like myself or Christian are going to use this taxonomy or classification structure to dive into topics and study things. We're going to be going into this a little bit later in the episode, not to give any spoilers, but you can do all sorts of quantifiable analysis. And then, lastly, I think something that's not talked about too often is lending. If you are a crypto lender, maybe you're not in the DeFi space, but maybe you're an over-the-counter lender, and you're trying to, measure, your exposure in your loan portfolio. Of course, you could use a taxonomy or classification structure just like you do in the traditional financial sense. So, yeah, I think these are, just a quick high-level overview of how the classification structures can really benefit institutional players.
Digging a little bit deeper, I want to get Christian to talk about some of the specific fundamental principles and the basis of classification for the CF benchmarks, CF DACS, the CF Digital Asset Classification Structure, because these are quite unique to our own taxonomy. So I just wondered if you could sort of give us an introduction and give us a sort of an explanation of that, Christian.
Yeah, absolutely. So the CF DACS, that is the CF Digital Asset Classification Structure, is in essence a robust and multi-level system for classifying and segmenting digital assets by their functional purpose. So we have a public methodology available for anybody to visit on our website, and that is in fact subject to very stringent rules. So one of the most important features of the DACS are the fundamental principles by which it is governed, as you well point out. And the first one is mutual exclusivity. And what this means is that no asset can exist in essence in more than one category at any point in time. Because if that was the opposite, if you would have one asset part of multiple categories at the same time, what you would in essence have is a mere set of labels that, from an investment perspective, for instance, is just not informative enough. And that brings me to the second fundamental principle, which is evolution, which is referring to the fact that the DAX encompasses today's as well as tomorrow's trends, while at the same time allowing for assets to move between categories as they evolve over time and as the industry evolves in itself. And last but not least, the third fundamental principle is universality. So what this means is that the classification must be comprehensive at all times and include all eligible assets in the universe. Now, having said this, another component, and arguably the most important one, is the method of classification that is employed in order to carry out the actual classification of the assets. First of all, the assets that the DAX classifies are, assets and tokens that are associated with a specific software protocol that, either operates a blockchain network or operates on top of a blockchain network, as Gabe was pointing out earlier. So the means to classify the digital assets in question is essentially by analyzing the usage and adoption of the software protocol associated with the digital asset in question. So, for example, just for visualization purposes, I think it's always easier to understand by an example. In the same way that a traditional automotive equity is classified as being part of the automotive sector, because at the end of the day it derives its revenue from selling, obviously, automotive products. Well, software protocols that are adopted and used in the area of, for instance, borrowing and lending, such as Abbott, for instance, which is in essence a platform for where you can borrow and lend funds, will be classified as an asset part of the finance sector in the DAX taxonomy. To be specific, it will be part of the borrowing and lending segment. And with this, the classification structure really enables the ability to group assets that are first of all correlated together. It can help define peer groups. It can also help to allow for the ability of measuring sectorial performance and allow to conduct overall different types of portfolio analysis, for instance. And all of this is intuitive, and sort of maintains fidelity to the nature of the digital asset class, which is the crypto asset class, and therefore to the blockchain economy.
One of the things that I realized when I first started writing about the DAX, which was probably sometime last year, was the fact that it was a highly visual system. In a way, visualization enables understanding of the system because it's a system that is intended to be sort of like remembered and utilized, I think, visually. Now, I mean, there's evidence of that because we do have on the CF Benchmarks website something which we call a token explorer. If you navigate to CF Benchmarks, go to CF DACS, it's one of the menu items at the top of the screen, you will find the CF DACS token explorer. So I'd just like to basically describe that to our audio audience right now. So the CF DACS is essentially, visually speaking, a tripartite system divided into specific categories and subcategories which relate to categories and subcategories of blockchain protocols, right? The first category that we can mention is the sector application category. It's sort of like at the top, and then there's another sort of a semicircle, a third of a circle, I should say, round. You have the settlement layer. Then a little bit further around, the third section of the circle, you have the services category. Now, these three categories are then subdivided into additional categories. So for sectors, it's divided into finance, culture, and industry. For settlement, it's divided obviously into programmable and non-programmable, which is, of course, essentially Bitcoin and Ether. And services is divided into infrastructure and utility. Now, Christian, I think the good way to go for this is if you could take us into some of the further subdivisions, like the segments and the descriptions of the subcategories.
Absolutely. I mean, as you well point out, Ken, there is further subdivisions of these subcategories in order to add this extra level of granularity to the taxonomy. And in fact, the DAX, what I would like to point out is that it has undergone some significant changes, which only happened, relatively recently, 1 or 2 months ago. And it relates in particular to having this third taxonomy level, and therefore contributed to one additional level of granularity to the classification structure itself, as I mentioned. So in essence, what this means is that we further broke down subcategories such as finance protocols or culture protocols, as you mentioned, into their corresponding segments, which sort of allows us to zoom into all these subcategories and see what their granular composition is. For instance, the finance segment can be further classified into trading protocols, asset and wealth management protocols, borrowing and lending, as I mentioned earlier with the example of Aave, and so on. Likewise, the culture subcategory can be further broken down into NFT platforms, social protocols, gaming, and other. And without going further into the weeds of it, this has also naturally been applied to the remaining categories in order to provide that extra level of granularity, which can be useful to better understand the behavior of our investment portfolios and decisions. And I think Gabe was mentioning earlier some of the use cases, but one of the most prominent ones that we've had is quarterly attribution reports that Gabe has been very kindly running for us. And I was actually curious about your experience with it, Gabe. Basically, what was your experience to run this sort of reports via the lens of DAX?
Yeah, I mean, I've found it to be immensely valuable in summary. And so, like as you mentioned, we do this exercise quite consistently now. Every quarter after each index rebalance, we run these reports and we break the performance down by all of these categories, subcategories, segments, what have you. And that really allows the reader to pretty much understand what really drove the performance of the market. So, for example, and we can throw up a visualization, on the video, but for those that are listening, you can run over to our website. We've got all of our QAR reports there, and they're pretty interesting to follow along with. But, for example, if we look at our diversified large cap index, we break that out by the categories, and you'll see just how, each segment gets bucketed up and how big the settlement layer one is of the index. And so what that tells you is, well, that weight's pretty significant, and that's probably me driving the index. So in the last quarter, we had pretty, I would say, narrow breadth of positive performance. And it was mostly driven just by those two mega cap tokens, Bitcoin and Ether. And if you were to look at our attribution report, you would see how everything else, could be red, but because of the small weighting in the index, you won't see that really materially drag down the performance, and the index will perform kind of mostly in line with Bitcoin and Ether in this instance. So you can have absolute performance on these tokens, like I said, deeply underperforming the index level, but as long as, these heavily weighted tokens are performing well, you'll see that the performance of the index can be quite good. So it really just kind of helps put this all in perspective. One thing that was kind of interesting that you highlighted when we were talking about, I guess, the evolution of the DAX, I understood that it went through some recent changes. We used to have just a 2-layer system, and now we're at a 3-layer, which is something that you were deeply involved with. So I think it's just important to kind of highlight again that it can evolve. This system can evolve. It's not, set in stone. And that's important because, again, when we think about why does the crypto space need a crypto-centric taxonomy, it's because the nature of the asset class is very nascent, and therefore it needs that additional flexibility to kind of adapt and change as, these trends develop and emerge. So if you were to just simply try and apply a traditional framework of another taxonomy that's quite popular, it just wouldn't kind of make sense. So we've got, I think, a nice treat for our viewers and listeners, right? I think we've done a little bit of homework. And Christian, you were kind enough to do, I would say, a pretty interesting analysis on beta and sensitivity.
Yeah, absolutely. Just before moving into that, on your point on the quarterly attribution reports, absolutely agree that they are, an excellent way to understand where the performance and risk premium is coming from, and by extension, what one's risk exposure is. Another very useful and intuitive case of the DAX that I don't want need to go unnoticed, and just very shortly to mention is, to sort of assess a portfolio's manager performance. It is always interesting to look at their excess returns and try to break them down into, different components that provide a more detailed and intuitive explanation of their performance. And I think a very good way to showcase this is, for instance, by using the Brinson model, which is a portfolio management model whereby the portfolio's managers' excess returns is in essence broken down into three components, notably two of them being the allocation effects and the selection effects, as well as a third component, which is a residual component, if you will. So the DAX is very useful here to understand the allocation effect in particular, which is in essence explaining how skillful a portfolio manager is at selecting the correct DAX categories or subcategories or segments. That is, how skillful he is at overweighting the outperforming categories and underweighting the underperforming ones. And all this is, reflected in the allocation effect, where the sign indicates if he did well, and in the DAX allocation, that is generated a positive allocation effect, and in the magnitude of the allocation effect, where a greater number shows a greater allocation skill. So, for instance, in essence, what this means is that if a portfolio manager has an allocation effect of 5 percentage points, that means that he generated 5 percentage points of excess return primarily from correctly selecting the right categories. There's also the selection effect, just for general information for our audience, which is in essence showcases how skillful the portfolio manager is at selecting individual tokens. That is the analogous of stock picking ability in traditional finance. So this is just another use case that I did not to go sort of unnoticed, as mentioned before, and that again can be very useful. Now, so having said this, and jumping into the beta analysis that you just mentioned, Gabe. Again, just for our audience to sort of get a good grasp of what we're going to talk about now. A beta analysis essentially consists of analyzing the sensitivity that a given asset has to the broader crypto market. So, for example, usually it will tell you if the market moves 1 percentage point up, then the asset in question will change X percentage points, where X is given by the beta. So, for instance, an asset that has a beta of 1 means that if the market moves 1 percentage point up, then the asset will also move 1 percentage point up. That is a one-on-one movement, if you will. Conversely, an asset that has a beta of 2, then if the market moves again 1 percentage point up, then the asset will move 2 percentage point up. And the same will happen with an asset with a beta lower than 1, moving therefore less than the market. So in essence, it can also be interpreted as a measure of risk relative to the market, where higher beta assets are riskier and lower ones are safer, if you will. And for those that are interested in the mathematics of it, just quick overview. It is actually very simple. It's basically obtained by running a univariate regression of the returns of the asset in question against the returns of the market. And of course, one might wonder what the market will be. Well, in the same spirit, as in traditional finance, where the market is defined typically by the S&P 500. Here at CFB, we have our own measure of the crypto market, given by the CF Broadcap Index, that invests in the top tokens that capture roughly 99% of the crypto total market capitalization, and where their weights of the different market constituents are weighted by their free float market cap. So, in a summary, this is yet another very interesting use case, how one would go about defining a market in crypto, about how one would go about measuring and interpreting the beta for the different assets.
And the idea is that basically with the CF DACS, you are you have a much greater facility to actually carry out such research or an experiment or analysis, because you know that the strong foundations of the CF DACS in terms of eligibility, liquidity, and so on and so forth for all of the assets within the DACS makes such a bit of analysis a lot more valid. I think that's what I'm getting from you.
Yeah, absolutely.
Now, I was going to say, I think it's really just about trying to find peer groups, right? I mean, that's really what this is all about. So for those that maybe get a little lost in some of the technical jargon, a univariate regression or something like that, aka that might just be like the slope function on the Excel. We can say that if you're interested in doing some homework yourself. But I think it's just, again, bringing it back to the DAX, I think it's just about finding these peer groups and defining a market. And so with the CF Broad Cap Index, it's basically the most institutional, broadest measure of the crypto market. And so we're excluding things like stable coins. We're tracking the performance of, I think, up to 99% of the market cap that has a certain degree of free float that's acceptable for larger players to actually invest into the universe. And then we can just take that universe and we can break it up into these peer groups. And that allows, I would say, both passive managers and active managers to basically define these peer groups and measure risk and performance as it should be appropriate. So if you have, a beta of 2 and you're not getting compensated for a beta of 2, then you need to probably revisit that. Again, if you're a passive manager and you're trying to replicate a beta of 1 and you're not getting a beta of 1, then there's something that you need to look into. So it's all about just having tools of measurement. And I think that's why it kind of fits so well from like an index provider standpoint, because we try to measure reality consistently here.
And you have a standardized taxonomy to give you reassurance that beta of 1 or whatever it is that you're looking at is indeed the correct or accurate beta for that particular asset within the universe.
Precisely, yeah.
Cristian, I wondered whether you wanted to talk about some of the, number one, the subcategory, category level analysis, and maybe even a patina or a little bit of the results. I don't know. How do you feel?
Absolutely. I mean, of course, we actually did run this analysis. We did this for the top 200 CoinGecko assets ranked by market cap. And, here at CFB, we only filtered for only 76 of these assets because, these were the only ones to pass the different requirements in order to really be part of our investable universe, where the requirements were some of the ones that you just defined earlier before, like liquidity measures, turnover measures, and so on. And so we downloaded price data from the beginning of 2022 until the end of July of this year, 2023, where we calculated the beta for each of these assets and then grouped them by their DAX category or subcategory and obtain the average beta in order to observe what the beta is for the different industries of the blockchain economy, which is the topic at hand and what we're interested in. And the results are actually very interesting. They're very intuitive and sort of expected as well. So in particular, we have found the settlement sector to have the lowest beta of the 3 categories. And just a reminder, the settlement category is composed by all the layer 1s, both programmable and non-programmable, that is, that support smart contract functionality. So, the non-programmable layer 1s would be, the likes of Bitcoin, and the ones that are programmable, those are typically referring to smart contract platforms such as Ethereum. On the other hand, the sector application category, composed primarily by finance and culture tokens, exhibited the highest beta, which is sort of expected again, especially from tokens related with NFTs and the like. And well, the services category, which is the third category on our first level of the crypto taxonomy, was sort of in between these two. And it must be said, though, that the category with the lowest beta, that is the settlement category, still exhibited a beta that was slightly above 1, which kind of told you that, if you really wanted to be exposed to a more defensive type of tokens, for instance, then, investing in the whole bucket was perhaps not the optimal decision. And this is where, the DAX's taxonomy granularity can really be helpful and inform of which subcategories or segments or the settlement category can provide that defensive position those low beta assets. And so we did that and found that indeed, from the settlement subcategories, we have two of them inside there, non-programmable and programmable, as mentioned before. The non-programmable subcategory has a significantly lower beta than the programmable subcategory, that is smart contract platforms. And that sort of makes sense, since the non-programmable, you're in essence looking at coins whose main use case is payment and store of value. And then in the traditional industry as well, the payment industry is perhaps one of the most, it's a very well-established industry and therefore fairly stable. And again, it's arguably the most established use case of crypto in the crypto ecosystem as well, such as, coins like Bitcoin, Litecoin, Bitcoin Core, Bitcoin Cash, and so on and so forth.
Cristian, I just want to interrupt you just 1 second there, because for our audio listeners, there are indeed a set of charts that represent this analysis. For our video listeners, they would have already seen it. If you're really interested in looking at those charts, scoot on over to LinkedIn and find this episode. You will find the charts there. I beg your pardon for interrupting you, Cristian, and please continue.
No problem. No, that's great that you mentioned it. I sort of kind of forgot about. So I think it's very important that you brought it up. Again, I think visualizing this kind of things is very, very important and make people get a much better grasp of the discussion. So as I was saying, of course, non-programmable coins, we found them to have a lower beta, a relatively lower beta inside the settlement category. On the other hand, its peer subcategory, that is the programmable side, which are mainly, layer ones with smart contract functionality, usually known as smart contract platforms. You're in essence looking at the likes of Solana, Cardano, Cosmos, which, but inherently they are much more complex protocols. And therefore, there's a high chance that there's more volatility or that the prices go a bit crazier. And if you look as far as 2 months ago, well, you had the SEC, for instance, suing Coinbase by claiming that some of these were securities. But perhaps that's another story for another time. And as I said before, if on one hand you're interested in low beta assets, well, you certainly must look at sector applications protocols, namely at the culture subcategory, where you are in essence investing in meme coins that falls under the social DACS segment, into NFT platforms, gaming, VR and AR protocols, and so on. Which, well, it is well known that these assets are extremely volatile. Therefore, justifying the high beta, you just only have to look at the NFT frenzy period, and then at the price movements of those coins during that period. So what we found to be relatively interesting is that inside the services category, which again was sort of in between settlement and sector applications, the infrastructure subcategory primarily composed of scaling, that is sort of like an interoperability, which is sort of layer 2s, as Gabe was pointing out earlier, as well as by computing protocols, has a very high beta as well. And therefore, during bull runs, the infrastructure subcategory could also be very attractive investment alongside the culture subcategory. And conversely, during a bear market is perhaps something you might want to avoid. We did the analysis across a bull run as well as a bear run. So actually during this scenario, both scenarios, the results were largely consistent as what we have been mentioning so far. That is, non-programmable coins and tokens exhibited the lowest beta across both periods. And culture and infrastructure exhibited the highest, both across bear and bull. It was interesting to see, however, that the finance subcategory must not be forgotten about, as it still exhibited relatively high beta, as it is part of the sector application category. And recall that this is the category with the highest beta. And in particular, the finance segment, what I wanted to point out is that it exhibits high beta during bear markets. So probably something to avoid during these scenarios, and stick with non-programmable layer ones.
Sure.
It's a very interesting analysis, and one thing that kind of stuck out to me is how it can kind of corroborate kind of a wider known narrative in the crypto space. So everyone knows this Bitcoin dominance chart, and you can kind of study it and you can kind of see that, when Bitcoin tends to dominate the rest of the market, it's typically because, maybe not good things are happening. There's, a lot of risk off sentiment and stuff like that. So it's very interesting to see how we've taken kind of a different approach. We've applied, our classification structure, studying, two different market regimes and seeing that these relationships are mostly consistent and kind of corroborate this historical, well-known narrative of Bitcoin dominance. And I just want to say one last thing that, kind of in summary, with this beta sensitivity analysis, it's basically gives the portfolio manager, in this example, if you are an active manager and your view is to be bullish and you think the entire crypto market's, going to outperform, you're going to be able to look at our taxonomy, our classification structure, and filter and screen through that, study that, and see, like the culture subcategory, or what was the other one? I think it was the finance one, are going to be higher beta segments that you want to have exposure to. So you don't want to be neutral those, you want to be overweight those. And you can expect, your portfolio on that overweight to just purely kind of outperform if these, relationships persist. So that's where I think it can be very useful on a practitioner level.
What I would ask you now, Cristian, is for practitioners and observers alike, casual observers like me, what would be your maybe 3 takeaways from your sort of commentary today?
I believe that the key takeaways are that, it is sort of imperative to have a taxonomy structure in place for the crypto markets in order to correctly understand, for one, risk exposure, to understand performance attribution, as we discussed just a few moments ago, either in the form of beta analysis or quarterly attribution reports or allocation effects across DAX categories or any other. And overall, and most importantly, to understand intuitively what a given protocol really does at its core, and therefore where one might be putting its money at. I think these are essential questions one needs to ask himself before making any investment decision, and a classification structure such as the DAX can just provide the tools in order to do so.
Okay, guys, that was really, really educational, informative, really enjoyable, illuminating conversation. We thank you a lot, Cristian, for coming along on the show, for doing all that work as well. I mean, it's not often we get someone doing actually a long piece of quantitative research before they come on to talk about it on the show. So we thank you a lot for that as well. So yeah, that's just about it. Regarding other content, apart from these podcasts, we do have a weekly newsletter. We do have a monthly market recap produced by Gabe Selby, CFA. And of course, at the quarterly level, we do have the quarterly attribution report, which uses which classification structure? Of course, the CF DACS. So if you'd like to see the CF DACS in action again, go find the most recent QAR report. We do appreciate you joining us for another time, and we hope to see you again for another episode of CFB Talks Digital Assets. Thanks for joining us.